Hi, Leeb Group viewers. It's Tuesday, April 27th here at Leeb.com, Leeb.com. Greg Dorsey with you. Well, Europe was at the center of trading today with Greece appearing to be moving closer towards defaulting on its debt, with Germany's Angela Merkel indicating that aid to the wayward EU partner is not assured. Merkel wants to exact stricter conditions tied to any aid to that country. Greek stocks plunged on the news to new lows. Yields on Greek bonds soared. But still wanting to placate angry voters at home, chances are the Greek government is not going to do much, not going to do enough in the way of spending cuts, and will likely ultimately default on its bonds. But the tragedy doesn't stop there. Fears that Greeks' woes will spread to other countries hit all of Europe. Portugal, Spain, Ireland were all down 4% and 5% today. Now, here across the pond, the U.S. dollar was up strongly on the EU's troubles, but stocks took a hit on the possibility that Europe's recovery will be, at best, delayed, and at worst, that the continent will slide back into recession. That would hurt prospects for earnings here of U.S. companies selling into those markets. And but all things considered, the performance of U.S. stocks there really wasn't all that bad, with small stocks hanging in there relative to blue chips. And if you look back over the last 3, 6, even 12 months, the strong relative performance of the small caps has been really quite impressive. And it suggests that we're not ready to see a major decline just yet. Now, on the other hand, it's not clear how much upside that stocks offer either. That 1220 level in the S&P is probably going to be pretty good upside resistance, at least for the short term. So most likely we're going to be stuck in trading range here for a little while. Returning to Europe, analysts at Goldman Sachs estimate that the region is going to need more than $200 billion to avoid widespread debt defaults, triple the sum that's currently being bandied about. And at some point, we suspect, and not right away, but at some point down the road, we suspect Germany, France, and the other stronger, more fiscally conservative nations of the monetary union are going to say enough is enough, and simply sever ties with the Greeks and the other nations that really can't seem to toe the line on spending. The EU itself will remain intact, but in its place of the current monetary union would be a much smaller, more fiscally conservative one, with a much stronger currency, much like the old German mark. Wow, okay, well that's enough for today. Check back with us again, and I'm sure we'll have a lot more for you. Thanks again.